Hello everybody, welcome back to ClearSurf Financial Education. Carl Keister here. Today I'm going to touch on a subject that I've spent a lot of time on in my 14 years of doing planning with folks, and that is the differences between mutual funds, index funds, and ETFs. So let's start off with the mutual funds. I think that's what people are most commonly know. And if you've got a 401k or an IRA somewhere, you probably have mutual funds in there. You just may not know the difference between the mutual funds and the index fund. So the mutual fund is nothing more than an investment fund where people take the money, they pull it together, and then they go out and buy individual stocks, bonds. It may even be short-term debt. Now these are professional money managers. So you're giving your money to a professional money manager, and you're saying, okay, you go out there, you pick the best stock, you want to time the market, you think when we should get out, especially with an election coming like we are, they're going to be thinking right now, should we get out? If a Democrat wins, they're talking about raising taxes. That could disrupt the market a little bit. If Republican wins, maybe it doesn't change so much. So these are all decisions the money manager has to make right now, is what should they do? So that kind of takes the pressure off you, but for that, you're paying a fee. A lot of mutual funds, you're going to pay fees of 1-2%, depends on what you go with. Now, there's always going to be lower cost choices. You've got the Fidelities, the Vanguards, even now Charles Schwab. They're all fighting to the death here, lowering the cost down to next to nothing on some of these trading costs. But with mutual funds, you still might have minimums to get in. Often, if you're in a retirement account, it may be a couple $100. But if you open an individual account, it could be $2,000 or $3,000 to get into that mutual fund. So you want to keep that in mind. So that is the goal. If you want to turn the money over to a money manager, let them make the choices. You don't want to read the financial papers every day. Then a mutual fund is not a bad choice for you. Yes, you might pay a little bit more in fees, but the money managers understand this, and their goal is to outperform this. So they're going to try to make some shifts in the portfolio to make more money because they know they're going to be getting compared at the end of the year, if not the end of the quarter, on their performance. So, and that performance basically is going to be geared towards an index or a basket of stocks. So let's say if you're buying a growth fund, you're probably going to be, that manager's going to be compared to the S&P 500. His performance would be, does he beat the S&P 500, beat it well enough to make it worth paying those fees? So that's kind of the goal of the manager. And they know that going in, so that's not uncommon. But what you would do is you would just buy this fund, and you're kind of hands off. You definitely should pay attention to it because managers sometimes can have good years like anybody else. And so you want to look at least on a quarterly basis when your statements come, or go online and view those to make sure you see what they're doing. And most importantly, a lot of people don't think about this. If you buy a index, you want to make sure your manager is not going out and buying small caps or mid caps, just trying to boost up his performance, just so he can kind of look better than he or she would be. But just want to be sure of that. So if you're buying a large cap index, you want to make sure they're buying large cap stocks and they're not cheating by trying to pull in some other to boost their performance. So that's very important to keep that in mind. But it is a good way to stay diversified and reduce your risk with mutual funds. Now, as your money grows and you go from a few thousand to you're talking tens of thousands, you also want to diversify inside those mutual funds as well, from growth stocks to value stocks, international stocks, even bond funds. So you want to start diversifying. This year is a great year. I just looked a little bit earlier on just to put up Vanguard's site just to see what the difference was on growth stocks versus value stocks, and what a difference. There's some growth stocks out there that may be doing 6, 8, 10%, and there's some value stocks that are doing negative returns by 6, 8, 10%. So this is a year where growth is favored, value's not. So you want to keep in mind, you want to think about that as your portfolio grows. Even though you're using mutual funds, you want to keep those diversified. Oil this year has done terrible. Real estate, not well. But then healthcare has done okay. So when you're looking at these sectors, these individual funds, you want to keep this in mind, stay diversified. Just because you're in a mutual fund, as the portfolio grows, you need to be aware of that and keep that in mind. So if you want to play it by capitalization, you can do small caps, mid caps, large caps, or play a sector. All these are available in mutual funds. Just keep in mind, if you have it in a non-qualified account, you want to be careful because the manager will be trading the portfolio more. So as they trade the portfolio, you're going to incur more capital gains. And what you want to keep in mind, most people have no idea of this. You could be in a year, say this year, the market tanks. Maybe it doesn't like the election outcome and the market tanks. Portfolio managers may be selling stocks and you may have held that stock for 1 year and you had a profit. You may get capital gains that you are not aware of because if they dump those shares, you may be receiving capital gains a lot more than the time you were in the fund. So that you want to be careful of with mutual funds. It's not discussed a whole lot. It's one of the secrets of the market, secrets of the profession actually. But be very, very careful with those mutual funds. If you don't have your own cost basis, you buy a mutual fund, you don't have your own cost basis. You're buying in a fund that may already be up 30%, and then it tanks. You may end up with losses, much more than you considered because when you got in. So bear that in mind with mutual funds. It's rarely discussed out here, but I'm bringing it to you right now. So the next thing is index funds. For those people that say, well, what if I just want to track the market's doing well, I think the election's going to go whatever way you think the market's going to go, the election's going to go the way you think, you may want to buy an index. So this will be basically saying, I want to buy the whole market. Maybe I want to buy the Wilshire 5000, I want to buy the S&P 500, I want to buy the QQQ, I want to buy a lot of technology stocks. So there's indexes out there for just about anything. And what you'll find is the cost on the index funds are it's hard to believe nowadays. I just looked at some of these Vanguard, Fidelity, Schwab. Some of these index funds are like 0.05, like 0.05%. It's a rounding error on your statement for most people. It's crazy how cheap they become. So keep it in mind when you get into an index fund, you don't have to do a lot of homework on watching the fund manager if he's doing his job or her job. Are they moving the funds properly, or did they time the market wrong? Get it right. If the market goes up, you're going to mimic that. If the market goes down, you'll get the same. So one thing you want to keep in mind, though, it is a passive form of investing. So if the market gets trashed, your value portfolio is going to go down. If you're lucky enough to be in technology back in March of this year and the market just ripped straight up, well, if you're in that sector that has performed the strongest, if you're in the Qs, you're going to see a huge growth. But if you bought value stocks as value index fund, your portfolio is going to be negative. I can almost guarantee that this year. So you want to keep that in mind. So if your goal is just invest, hang back, and you don't want to watch the market every day, you don't want to read about what this company's doing or this manager's doing, indexing is not a bad idea. Low cost, keep your costs down. Structure is pretty simple to follow. If you want to buy the Russell 2000 small cap stocks, if you want to buy the NASDAQ, it's 3,000 roughly of technology related stocks. But keep in mind though, it's not complete diversification. So many people think, oh, the NASDAQ's 3,000 stocks. I just pulled it up today. 56% of the QQQ is in 10 companies. Yeah, 10 companies. And of course, some of the best 10 companies that are performing this year, Microsoft, Apple, the list goes on. But keep in mind, you might think you're diversified with 3,000, but the bulk of your portfolio, 56% as of today, is in 10 companies. Keep that in mind. So indexing, you can see a big run up. You can also see a big turn down if these indexes go the other way. Now, so if that's your idea of investing, keep in mind, if you want to just mimic, you don't want to do the homework, you want low fees, you don't want a lot of capital gains, but you want access to the market, indexing may be the way to go for you. It's kind of a set it and forget it kind of mentality. Now, the other thing you've seen a lot more of lately is ETFs, exchange traded funds. Now, exchange traded funds, you can pick, it's very similar to the index, as a lot of them do actually follow an index, but you can also play individual sectors. So if you think, again, gold, you may want to look at the GLD. It's one of the largest ways to track gold. If you think gold's going to spike, you may want to think about gold miners. Now that will move, if a gold ETF GLD moves 1% or 2%, a gold miner ETF could move 2, 3, 4, 5% in a day. So much more volatile. So we want to keep that in mind when you're looking at ETFs. That's one of the benefits. The other benefit of an ETF is you can sell it in the middle of the day. So if you're owning mutual funds and you sell it, you get the closing price at the end of the day. If you're in an ETF and you sell it at 12 o'clock, you get the next person who wants to buy it. You get the next bid and you're out. So you want to keep that in mind. You may have some more trading costs associated with that, but a lot of these brokers have pretty much eliminated all trading costs and commissions on many of these ETFs, especially the larger ones. So I'm sure if you want to get into something, you can find an extremely low cost ETF and not have to worry about a whole lot. And it allows you to play market sectors too. It's not just small cap, large cap, gold, silver, anything you can think of. If you're worried about the environment, there's ESP funds out there. So anything you want to get involved in, it's pretty much out there. So keep that in mind. But in ETF, same things. You want to be careful you don't get too overly heavy in one end or not. You can go stocks, bonds, commodities, technology, play the stack of derivatives. So just wanted to bring that to you. That's the main differences. For some people, their largest investment might be a home. Other people could be a 401k or an IRA. And other people may just want to open up a brokerage account just to get familiar with the differences and start to play a little bit with what it means. If you want to be a little more hands-on, then ETFs may be the way to go. You can get in and get out. But if you don't plan on getting out, maybe indexing is best for you, because you can get in that fund, low turnover, let it go, know that you're going to get based what the market is going to produce, and the market has produced much higher returns than a lot of investments out there, particularly cash right now. Cash is getting zero in the bank. So if you go into an index fund and you're patient and you've got a couple years, I'm pretty confident you're going to do a little better than the cash. Goes without saying. But again, I just wanted to bring that to you. So hopefully you got something from this. Please give me the thumbs up if you like the video. And there'll be a link down below to a course I've created if you want help with trying to get your financial house in order. I go through a lot of different things, from budgeting, tax strategies, investment, retirement, estate planning, different risk management tools. So again, I'm going to keep bringing these videos once or twice a week. If you would like any other topics to be discussed that I may not hit on so far, let me know in the comments down below, and I will do my best to get this to you as soon as I can. So once again, Carl Keister, ClearSurf Financial Education. Hope you have a great day, and take care.